Beautiful music. Hey, everybody. Thank you very much for joining us. For all two of you. I appreciate that. I'm Lee Seiler, also known as the Stock Doctor. In the house with me is Nikki Ward. She is our chief CFP at our office at Seiler Wealth Management. She's also Chief Operating Officer. You get so many accolades these days, Nikki.
Chief. I'm just trying to collect letters. Really
collect letters. That's all you have to do.
Just have the alphabet next to my name. That's really what I
well,
want.
We haven't done this in a very long time.
It has been a minute. We've been dormant for a while, but we're back, baby.
We're back. And, people have told me since we've been on our hiatus, they're saying, why aren't you doing it? It's very helpful. I liked what you guys said. There's stuff going on in the markets I want to know about. And I have no excuses.
Life
I have no excuses.
Life got busy.
Life happens. But anyway, this is a very, very casual, quick 20, 30-minute episode. We're going to do this on I'm not going to commit to a weekly basis, but what we want to do is educate folks out there. We want to talk to them about what's going on in the markets, some things that they can help their portfolios, and there's pitfalls out there that I want to make sure that, and we want to make sure that people don't fall into.
Absolutely. We're here to talk markets and money.
Yeah, markets and money, which I love this. I love markets, but I love money.
I was going to say, you can't really... I don't know, one without the other.
And we're back in front of the good old bar, which I love that too.
In your basement?
Mm-hmm. My basement here in Florida. Okay. So, look, it's been a real interesting half of the year thus far. And, we had a really, really nasty correction. And with an unbelievable recovery. Quite frankly, I had no idea that this recovery could happen as quickly as it has. And
the V bottom has been such a head turner. It's been so fast.
And V bottoms, I used to say typically don't work, but in this case, a V bottom has worked. And I'm going to get some charts up in a little bit, but I wasn't prepared for that. But what I want to do is I want to show people that because markets do tend to correct. Mm-hmm. And there's a definition. The definition of correction is when the markets are down 10% or more. Definition of bear market, 20% or more. But pullbacks occur multiple times a year, Nikki. They occur quite a bit.
They do. And yet every time that they happen, it's as if they've never happened before.
Oh, yeah. Clients are crawling up into a fetal position when your markets are down 5%.
It's the worst. The absolute worst thing that could happen, despite us trying to set expectations consistently and constantly because we expect this to happen. This is one of the things that I can pretty much use the G word for, of guarantee, is that we're going to have at least one pullback of 5%.
Yeah, and actually, usually on an annual basis, it's 3 times.
But
so
I can definitely promise we're going to have one.
Yeah, and every 16 months, you can expect a 10%. Every 3 years, a 15%, and every 5.5 years, a 20%, which is bear market. Now, in this case, however, we had a 20% plus correction in 2022, or a bear market. And then this year, it's incredible because we had a market that dropped almost 20%.
Yeah, just shy. We're flirting with it as far as the NASDAQ was concerned.
Yeah, just shy of 20%. I'm trying to get some charting up here while we're talking about it. But yeah, the markets were down almost 20%.
And the S&P 500 is up 28% from the April lows. So we have seen a miraculous recovery in such a short period of time. It's been incredible.
Yeah, and we believe that the volatility is not going to be over. So
that's something we can also what was it? It was uncertainty is the new certainty. Like you absolutely know it's going to happen.
Yeah, and one thing you got to look at is since the last bear market was 2022. Mm-hmm. So we had 23 was a great year in the markets. 24 a very good year. So history shows us that year 3, which is right here, year 3 after the first year of a bull market. So year 1 average, this is back since 1946, but year 1 of a bull market usually returns, this is the S&P 500, almost 40%. Year 2 is 15%. And then year 3, which is the one we'd be in now, is only 2.5%. So it's not down, but it's not up, and it's not up much. But after those previous 2 years, who cares?
Yeah, I mean, I will say I have had some clients that I had to remind that, you're not going to always be spoiled with returns of 20+% back-to-back years. The last time that we saw that was back in the 80s. So, that was something that you have to kind of rein back in,
And look,
And my own self too. Like I have to remind myself as well, you're not going to get returns like this every year. You're not going to hit it out of the park every year.
no, and you know what? Through half the year, we just turned in positive territory not long ago. The month of June was outstanding for stocks. And right now, the Dow year to date, we are halfway through the year. The Dow year to date's up 4%. The S&P up a little over 6%. The Nasdaq a little bit over 6%. And today we had a pretty good day. Up 217 on the Dow. S&P up 37, NASDAQ up 192. We had some historic things happen today.
Speaking of historical, can I just get nerdy?
Yes. I know you're a nerd.
So July of 1995, the NASDAQ crossed the threshold of 1,000 points for the first time.
I remember that.
Yeah.
I remember that. I celebrated in the streets.
Of New York, right?
Yeah. And now the NASDAQ is 20,600. And look, why did the markets drop? I'm going to try and get some charting up here. And see, let's look at what the markets did, because back in the early spring,
April showers.
Yeah, I mean it was bad. So here is the drop. You had an all-time high. I mean, you were hitting. Let me get some. I want to get some notation here.
You love a pen.
I love the pens, but is it not working? Okay, hold on. Oh, there we go. Okay, so early spring, that's in February, middle of February, we had all-time highs.
Mm-hmm.
Then we had a precipitous drop all the way down to 5,100 on the S&P 500. That was 1,000 points. So that was about 17%. So pretty darn close.
Yeah.
And here's what the key was, is that I always hear people say, oh, and the whole talk was tariffs.
Mm-hmm. It was all about the tariffs. It was Liberation Day. I think that the day of Liberation, we saw broadly the indexes were down about 5%.
Yeah. And so people think that the world is coming to an end. It will never come back. And you hear this.
And Wall Street is the worst culprit of them all. Wall Street overreacts consistently.
And the media doesn't help.
Oh, yeah.
Because the media tells you, oh, there's 30% tariffs. And
yeah, if it bleeds, it leads, right?
Look, first of all, I think we know what our president's game plan is. And he wrote a book, Art of the Deal. And we know this, that your first offer is not your best.
No, you want to ask for something ridiculous. So that way, what you really want, you get to say that seems, oh, well, yeah, why wouldn't I do that?
So, the markets, and I'm going to share with you again.
It's the taco trade.
Yeah, so the markets tanked. People got nervous. Actually, got down to 4,800. So we were down closer to probably darn near.
I think we were like 19%.
Yeah, it was like 19%. And that for all intents and purposes, let's call that a bear market. But what I love is that we saw some opportunity out there. And in our practice with our clients, we have the wherewithal. I don't want to say balls, but yes, we do. I mean, because you're a female.
The cojones.
But yes, but you're a female with cojones.
And the ovaries.
and we go out and we try and find disconnections.
Mm-hmm.
And I love this, whether it's in the bond market, whether it's in the stock market. I love disconnections because disconnections, they don't last forever. And if you have something that like this, and this, you knew this wasn't going to last forever, just like COVID, just like,
it never lasts forever.
It never does. But people think it is. So you take advantage of that. So we did a lot of buying, and clients are very happy about that, and we're glad. But then if you look, you had a great recovery. I mean, it's a historic recovery, and this is what I call, folks, a V bottom, and that is straight down and straight up for the most part.
Yep.
And right now, in my opinion, the market, I think, is a little bit ahead of its skis. It's a little bit overbought, and we are not taking any big bets on because we already did this.
Yeah.
We bought, and we already own things like NVIDIA. We bought more when this market was down. And NVIDIA, from peak to trough, this year was down at one point
40%.
40%.
That was when we had the DeepSeek scare, when China came out and said that they were going to be able to do exactly what NVIDIA does, but just, way cheaper. But, NVIDIA is definitely not for the faint of heart. It's been a volatile ride, but it's definitely worth it.
But it's our number 2 position for our
Right.
clients as far as individual stocks are concerned. And
It's the most valuable company in the world.
it is now. So today was historic because NVIDIA did hit the most valuable company in the world. So let me just show you what NVIDIA did and what Nikki's talking about. NVIDIA hit a high back in January, or just beginning of the year, January 6th. It was 153. Dropped down to $86. 86. And we did pick up shares, not at 86, because nobody's going to catch the very low. I mean, that's one thing we like to tell people. You're never going to catch the very low.
Nope.
You're never going to sell at the very high.
Nope.
But when you see a disconnection like that, and we knew, all right, the DeepSeek thing, I knew it was just a farce. I knew that it was okay. Yes, it's Chinese propaganda. Yes, they're legit, but this was real. NVIDIA, and I'm not one that buys into these little trends. And you know that I was not a big crypto guy, and I never have been. And I'm still, do I own some personally? Yes, but it's not a lot, and I don't care. But I believe in this. I think AI and what they're doing, that is legit, and that is really happening.
Well, and I think the main differentiator with AI is that you're using it in your everyday life. So not only do you believe in it, because it's not something you have to have faith in, like cryptocurrency that nobody can explain in plain English. I'm using ChatGPT. I'm using, Copilot. I'm using it in my day-to-day life already. And so you're already seeing it being disseminated. And
college students are using it for papers. I love this for them. No, but it's and we have an intern, by the way, so we know all the scoop.
Yes, we're getting all the.
We're not going to mention names of our intern, but he's a good kid.
Yes.
But so things like NVIDIA and all the semiconductors dropped, technology dropped, and the key is here, Nikki. What I'm trying to get to is that you can't own technology and crawl up in a fetal position when they drop 20%, because, as you said, NVIDIA, the most valuable company in the world, was down 40% at one point this year.
Exactly, and you've got to stick to the long-term plan as long as the company's financials and the fundamentals are sound. That's what's important.
So that being said, I want to go to this next point, is that because you hear these stocks on the headlines doesn't mean they're ready to be bought.
No. And for the most part, by the time that you're hearing the headlines, I feel like you might have missed the boat.
You can't. Rule number 1, and I tell this to people, our clients know this. People that aren't our clients don't know this. Do not chase.
Yes.
Because stocks can get away from you. NVIDIA.
Let them get away from you.
I look at NVIDIA. Look at this. A straight shot from 86 to 162. Almost a double from, what was that? That was from April 8th. Almost a double since April 8th. So we didn't buy it there. I told you we did, but I have some people that are up 40 to 50 to 60% NVIDIA in that period of time. So we bought it probably over here. But my point is, look at where the stock is, and all-time highs is a good thing because that means that they're hitting on all cylinders. However, that doesn't mean it's a great buy point because these are moving averages here. It's a 50-day moving average. This blue line's a 50-day. I'm really not going to get into this because it's too much. But it's way above its 50-day moving average because all stocks, based on history, all stocks will come back, either meet their 50-day moving average or they'll trade sideways and meet their 50-day moving average. In this case, I don't think NVIDIA is ever going to trade sideways, but it will pull back and you'll get another opportunity at some point.
And to your point earlier about that you're never going to catch the lows and you're never going to get out at the tippy top of the high, what we try to do is once we see something pulling back to the 50-day moving average or when we see a disconnection in the market, we're trying to just get on the escalator. We just want to make sure there might be, half of a position that we take. So that way, if it goes lower, then we can just average down. If we still believe in it and we see that, it's trading sideways, okay, great. We'll just pick up some more. A great example of that would be United Healthcare.
Yeah, I love United Healthcare. It's the stock is been destroyed. It's down 50%. Look, you have some tragedy with that company, all right? The CEO got assassinated right there in the middle of Manhattan, and then the other CEO resigned, and they have Medicare fraud allegations. There's a lot going on, but I think down 50% is probably a little overdone. That's a disconnection.
Yep.
And it's not going to happen tomorrow. And if you buy the stock, a UNH, by the way, if you buy it, and I'll try and find a chart on it, but if you buy the stock, it's not going to happen tomorrow. But what I think is going to happen is at some point, we're going to go in there and they're going to say, oh, we're okay, because UNH is saying, go ahead, investigate us. We feel fine with you taking a look at everything we do. And the stock was down a little bit today, but it's been hovering at 300. And UNH is the biggest component in the Dow Industrial. So here's what we have. UNH was at 600 and change. By the way, these are not buy recommendations for anybody.
Nope.
Until you talk to somebody. All right. Talk to a financial advisor, somebody you trust, or you could call us.
Preferably someone who's a fiduciary, please.
Yes. Talk to us. But this is UNH. All right. $600 down to $300.
It got as low as 287.
It did get as low as 287. Now, keep in mind that it is a Dow component. So what that means is, we just said that the Dow is near all-time highs.
Mm-hmm.
If UNH was trading flat at 600, because UNH literally deducted 2,100 points.
The 7-point swing.
7 points per point of the Dow stock going down. I know it's confusing. It's down $300 a share. Each Dow stock represents 7 points on the Dow for every dollar. So down 300 times 7, UNH represents 2,100 Dow points. 2,100 Dow points. So if you had UNH flat, the Dow would now be at 46.5.
And that's why I still think that there is room to run within the bull market. I do think we are absolutely due for a pullback or just even trading sideways. But, and we'll see what happens with the August 1st deadline of the tariff tantrum situation. But, you know, I don't think that this is the end all be all, but hopefully there's some opportunities for us to buy.
Yeah. Look, I like corrections. We always, and you know,
it's so funny. We love the most terrible things.
No.
When bad things happen, we're like, yes.
I don't like
rest
that
of the world.
because corrections affect everybody, all clients. So our clients are down too, but we have strategies.
So are we.
What?
So are we personally in our portfolio.
Oh yeah, but we, you know, our clients aren't down as much.
Yep.
We have strategies that help them. However, those disconnections is when we make our most money. So next time we have a 15% pullback of some sort. Right now, I think we're kind of the path of least resistance is to the upside.
Yes.
However, we are entering earnings season, and anything can happen. Let's talk real quick, Fed talk, because beginning of the year, the thought was, and the market had priced in 4-ish rate cuts, and certainly we've had 0 this year. Now, and let's talk about why we had 4 priced in, but there's been no rate cut so far. Let's talk about that.
I mean, I would say that I think that the market got a little bit enthusiastic. I mean, 4 rate cuts was overconfident, in my opinion, prior to the start of the year. But we've had, I mean, consumer spending remains strong. That makes up 3/4 of our GDP. I mean, so we've had a strong economy despite everybody crying about a recession last year.
Well, and here's the other thing.
A tight labor market. We've not had unemployment skyrocket.
But Jay Powell.
And we pulled inflation down.
And I believe it's Jay Powell's looking at the tariffs. Because tariffs are inflationary. They are.
And we came into this year not knowing the policy direction at all of this administration.
Yep.
And so gaining clarity there, understanding what's happening, seeing if the tariff situation was going to impact inflation, if we're going to have stagflation, that is something that I'm looking forward to going into earnings season.
Well, I think that, and then the reason people are thinking September rate cut is because Jay Powell, who I believe has been a great Fed chairman. I really do, no matter what our president says. And I don't like that disrespect going back and forth, just forth.
Yeah.
But I think Jay Powell is a really, really smart man, and he knows. Yes, he would. Jay would probably love to cut rates, but
Yeah.
he's not sure the impact of the tariffs. And we don't know because these deadlines keep getting pushed around. So if these tariffs end up being like what the market is thinking they are and a little bit kind of curbed, then I think there is room for Jay Powell and the Fed to cut rates probably twice this year. The talk is September is moving up in percentage-wise, and then one more after that for the year. But that's only 50 basis points. That's not going to change anybody's lives. But what it may do is ease a little bit of credit card debt. Maybe, and by the way, just because the Fed cuts rates doesn't mean mortgage rates go down because it's all about the 10-year Treasury.
Yep.
But maybe, though, you do have that happen. Maybe the 10-year Treasury says, okay, let's pull rates back a little bit. But
It's
rates
not
go
going to be instantaneous.
No, and rates go down. Rates go down because the economy is suspect.
Right.
There's concern.
Exactly. And so, it's funny because it's like you don't want it to happen. You don't want rates to be cut, but on the other hand, you do. For certain reasons, you want rates to be cut because you want people to be able to afford homes and get mortgages. And for that part of the housing sector, like you want that. But then for the other part of it, the economy, you're like, ooh, we're on shaky ground if we're cutting.
Yeah, and you know what? That's where it's you don't know what's going on out there. You have to really look at your portfolio and see where things need to be trimmed or added to. There's always a place for fixed income in a portfolio. I mean, most of our clients are pre-retired or retirement age. I mean, I know you guys, we're a multi-generational firm. I'm
you
happy.
gotta speak for yourself.
Okay, we're multi-generational. I happen to be the older generational.
You're the boomer.
I'm the boomer, yes. The last year, though, I love being a boomer. Love it. But I believe that we have to look at our portfolios.
Absolutely.
Make moves based on what we think is going to happen and how the economy's going. So if you can't do that, we have a number here. Call the office. We can help you with that. We do financial plans. Nikki's a certified financial planner. She's way up there. She's way above me and every accolade in the world.
Just letters.
Letters. I love the letters. I love the letters. But we also do a lot of other things. We do a lot of estate planning too. So wills and trusts and things like that we can help you with. But one thing is, I just want to end this because I think it's the most important aspect is when you hear something that, oh, I want to buy CoreWeave, or oh, I want to buy NVIDIA, or oh, I want to buy these things that have been running, don't chase. Because chasing stocks will absolutely, it will hurt you.
Yeah.
It will hurt you.
It's going to punish you. And most people who don't have an advisor are getting in at the top and they're selling at the lows because they don't have the emotional component of when we say we make the most money when there's a pullback or a bear market. We also are doing the most as far as psychology is concerned and being, kind of that armchair psychologist for our clients to say, take the emotion out of this. Like, it doesn't feel good, absolutely, and we can empathize with that. But, part of what we do is protect people from their own selves.
I mean, we have actual protection in clients' portfolios, which nobody out there, I mean, any other money manager out there, they can say, oh, we'll do this, we'll do that. No, we have contractual protection. So that's kind of what you want. You want to make sure that, hey, I can participate on the upside, but not get absolutely hammered on the downside. So we're going to have more of these. So I don't want to get it. We could talk all night.
Yeah, we could.
And go over everything. But, I promise, Nikki, you commit. You do more of this?
Yeah, absolutely.
Okay, you do more of these. You guys are awesome. Thank you very much. I am Lee Seiler with Nikki Ward and Seiler Wealth Management. You guys have been awesome. Thank you very much. If we can help you, give us a call right there. Is 407. Oh, wait, 40. Oh, no, I'm watching the screen. 8318. Okay, thank you very much. You guys are awesome. Good night.